Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us now, the one that puts Greek and Latin into our bond coverage, Bob Michael of JP Morgan. How do the Greeks right now, the derivative Greeks, play into what you do? When you look at the quiet of holes in the market or a new volatility, maybe it's skew that you play into, how does the derivative space fit in?
They're critical to what we do in the markets. I think so much of what you try to do is in the cash market, but there's limited bandwidth. Broker-dealer balance sheets aren't what they used to be.
Right.
And a lot of the balance sheet in the industry sits with investors like ourselves. And we tend to own securities until we change our mind. So we're not in the market actively trying to change positions. You go into the derivatives market to help you change the positioning of your portfolio or perhaps put a bit of a hedge on.
Is there Bob Michael, and I think of Ian Lingan at BMO Capital, you're saying we're going to see price up, yield down. Is there a bet in the space now, like what you believe, that we will see as a regime lower yields?
Well, it's everywhere. We liken the current environment to 1995. There's one critical difference. When the Fed finished hiking rates from 3% to 6% in 95, the entire yield curve was above the Fed funds rate. Today, we think the Fed is done hiking rates, but the entire yield curve is trading roughly 100 basis points through the Fed funds rate. So that's telling us that the market still believes that the Fed will come in, take pressure off of businesses and households by doing at least a few rate cuts over the next 12 months.
Bob, we're sitting here with the 2-year Treasury almost at 5% here. I don't know. I'm going to park my money right there, and I'm going to feel fine. Is that a bad trade?
It's not a bad trade, but you may feel lonely compared to the money that's sitting in money market funds. You're willing to step out, but what we're looking at is over $6 trillion of assets sitting in money market funds.
Yep.
And they're feeling cozier at somewhere closer to a 5.5% yield. For that money to come out and come into the bond market, we do need to see the Fed begin to cut rates, or at least telegraph that they're thinking about it again and not dropping these hints that maybe rates could go higher.
So what do you think our Fed should do? I mean, the economic data suggests that maybe there's no reason to cut rates. We've got, I don't know, inflation's still out there.
If I were at the Fed, everything looks so good. I would just sit on my hands for the next couple quarters, see what happens into the election, and do nothing. You're looking at over 2 years of unemployment below 4%.
Yep.
I know we get PCE at the end of this week. There's a lot of debate. Is it going to be 2.7 or 2.8 year over year? Is it a 0.25 or 0.27 increase? The reality is 2 something year over year is much lower than the 6.6% year over year it was a couple years ago.
Is a stated system, is there leverage in the system? Is there that animal, I don't want to say animal spirit, that ancient animal instinct to leverage up when we're certain we know what we're doing? Is there that bet right now?
You're not seeing it to the extent that we saw it previously, either headed into the dot-com bubble in 2000 or certainly into the great financial crisis in 2007, 2008. But there is a lot of borrowing going on out there. The most levered balance sheet are not businesses and household, they're actually federal governments globally. When you look about the extension of credit into the system, bank balance sheets may have shrunk, but private credit is out there.
But the heart of the matter, going back to Rogoff and Reinhardt, this time is different, is they took within their iconic study of debt that it's about public and private combination of debt. Would you suggest we're going to see a private debt issuance and build up in belief in debt? So we've got both public and private over-indebtedness?
It doesn't feel like we're heading there.
I agree.
Right now. It feels like, and I know you did a story, that consumers are looking to do a bit more vacationing, and a third of them are willing to put that willing to go into debt to do that. Going into the financial crisis, 120% of them would have been willing to have gone into debt to go on vacation. So there is some moderation. You look at housing. Consumers aren't chasing housing prices higher.
Well, let's listen to our Latin tour guide here as we go to Rome. Greek?
Arma virumque cano Troiae qui primus aboris.
That's great. Yeah. And that's like Lisa Matteo's scheduled to go to Rome here. She's going deep into debt to go to loan so she can catch up with Bob Michele on the Latin. That's perfect. It's out there as well. It's going to happen.
Bob, what do I do here? And if I want to take some credit risk here, do I stay with investment grade? Do I go to high yield? Because high yield was the performer last year in the fixed income space. Where do I go in the credit space?
You hope that over the next week, high yield pulls back a little bit further, and then you go in. Without recession on the horizon, you have nothing to fear but yourself if you stay out of the high yield market. You're picking up now yields of over 8%.
Wow.
Corporate profitability looks good. It's a much cleaner high yield market than anything in my lifetime. 6% of it washed away back in 2020.
I guess I got to go to the Fed meeting as well. The basic idea is it's a snooze fest to get to June when they redo the dots. And there's a raging debate now, Craig Torres with great leadership on this over the weekend, about the Fed almost over-communicating. Is your world made more complex because there's too much communication from Fed presidents, governors, and leaders?
You know, Tom, the one dead language that I miss is Fed speak. Remember in the days back in the 80s when the Fed wasn't always telling you every day what you were thinking?
I yearn for it.
You used to get the Fed minutes. You used to listen to the Humphrey Hawkins testimony. You heard what Greenspan said. Then you got out your secret Fed decoder ring and interpolated what he meant. And there was a value to that. And I think there is just way too much daily information coming
Paul,
from
the most important conversation I've had on this is someone that Bob Michele knows, Richard Berner, who drove the ship at Morgan Stanley for Steve Roach for years in the U.S. economy, public service to the nation at Treasury. And what's so important here is there was just what Mr. Michele says, and then you would go see a president at a Rotary Club or some other economic club, and they'd say just as little at the breakfast as they were saying to us on the street.
Bob, you're head of the Global Fixed Income, Currency, and Commodities Group here. Let's go currencies. Is there a bear case for the U.S. dollar here, or are we just all long the U.S. dollar and letting everybody else deal with it?
There's a bear case for the dollar when the Fed starts cutting rates. Until they do that, there's no sense fighting the strength in the dollar. If you look at when the dollar really started to gain strength, it's when the Fed started hiking the Fed funds rate at the start of 2022. Back then, yen was about 110, not 150. The entire strength in dollar yen has come from the Fed hiking rates, not anything that's happened on the Bank of Japan's part.
So, and we see central banks around the world cutting rates or saying they will cut rates, signaling that they will cut rates. So, I mean, how does the Fed think about the dollar when they think about their rate policy?
You're right. There have been 7,000 basis points of rate cuts in the emerging market central banks. So those central banks have been cutting rates for over a year. And I have to imagine they're starting to second guess whether they need to keep cutting rates here. I don't know that the Fed thinks about the dollar all that much. If we go back, we were just talking about the Fed speak of the 1980s. I remember we used to look at the TAN book, we used to look at the minutes, we used to see how they prioritized inflation, growth, and the dollar. And many times the dollar was their number one priority. I don't think it's their priority right now. I think it's a huge one for the ECB and the Bank of Japan.
Bob, in the time we've got left, I really want to focus here on into the earnings season and corporate issuance. Off of like Zvi Bodie at Boston University or there's a thing, folks, called M&M. It's not the candy, but it's a theory here on the allocation of your capital structure to debt. Are we underdebted right now in quality corporate America? Do they have not enough bills, notes, and bonds?
I think we are. We have spent the last quarter trying to poke holes in corporate profitability in the markets and at JP Morgan with our credit research team. And they can't do it. And instead, what they're seeing is a re-acceleration in corporate profitability and businesses thinking about investing in CapEx again. It looks pretty bright out there for corporate America. It does remind me of 1995.
Do you suggest bond issuance will be the surprise of the next 18 months?
I don't know. I think there's a shortage of corporate debt right now. We were looking out over the next couple quarters, and there's more money maturing than there are planned
Paul,
issuance.
What you just heard there, folks, is classic John Templeton from Bob Michael. I'm sorry, Paul. I'm in this camp. There's a shortage of bonds. Nobody's looking at the Bob Michael world, and it's a tangible part of how we do this, and it links into the equity market, and there's just a shortage of bonds. That's all there is to it.
I mean, Bob, you're at JP Morgan Asset Management. You guys are pretty big. If you wanted to get out of a position, change a big allocation, is there enough liquidity on the street to kind of get that trade done to your liking today versus 10 or 15 years ago? How much harder is it, if at all, to kind of make major trades for you guys?
Right now, when things are relatively stable, you can do it. It will take a little bit of time depending how large a position you're trying to move. There's a lot more in portfolio trading, so hundreds of line items all at once at a single price. That's a feature that didn't exist pre-financial crisis. But when everyone is worried and everyone's pulling back liquidity and their balance sheet, then it is far more challenging than it was pre-financial
You're JP Morgan.
crisis.
You say, get that trade done for me, right? I mean, you guys are players.
You try not to do that
because
you are reliant on a counterparty. I think that's a pre-financial crisis
Is that
type
right? Okay.
attitude.
Let me pin down the 10-year yield 12 months from now. Just a vanilla media call here for animals like me.
I think we're going to be right around 4%.
Down, but not down with the drama that financial media
Not
demands.
a whole lot. Not a whole lot. I think the Fed could probably get 100, 125 basis points of rate cuts.
So are you doing cliff notes now on Fed Speak? If you got Greek and Latin down from your undergraduate days,
I don't.
Are you looking at Fed Speak?
I don't need to do it. They're telling us every 10 minutes what they're thinking. You don't need cliff notes.
Bob Michael, thank you so much. Just generous with his time here on a Monday morning. He, of course, is with JP Morgan.